Welcome back. Hope everyone's doing great and you've had a great day. Now, what we're going to be looking at today is, as we promised last lesson, is we're going to take a look at a bit more market psychology and psychology of trading. So take a minute, have a think about this. What do you think this is referring to? All right. So here we've got a table showing a recovery after drawdown. We've got some drawdowns. We've got some gains to recovery. All right. What do we mean by drawdowns? Drawdowns is basically how far down have you got? If you started with £10, are you at £8? Are you at 7? Are you at 6? Your gain to recovery is, what percentage increase is required for you to get back to break even. All right. So this is put here because I want to talk to you today about the importance of position sizing and risk management. Now, position sizing or risk management, you can look through the web or look at the internet. All right. You're going to get a mixed bag when it comes to the definition of position sizing and risk management. You're going to get a lot of people that talk about, diversifying your portfolio. You're going to get a lot of people that talk about, picking the right winners and making sure you've got the right asset, crypto, future, forex, blah, 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 blah. All right. But in my opinion, a lot of that is BS. Okay, when we talk about position sizing and risk management in trading, I want you to think about it very simply. It is selecting the right amount of capital to risk per trade. Why? In order to be profitable in the long run and, not the long run, the long run, and also to be in the game long enough for your system to do its thing. In my opinion, this is the most academic, the most elaborate, the most concise, precise. This is the best definition in the world of risk management. Okay, if you fully understand this, you are better than 80-90% of people using this app right now. Okay, all right, now this and misunderstanding this is what leads to a lot of it's what leads to a lot of people failing at trading. It's what leads to a lot of people quitting too soon. There's a stat out there that a lot of people like to throw around, which is like 80% of traders quit after X amount of years, or only the top 5% of traders are profitable, blah blah blah. But it's because of this. All right, I'm not saying those stats are valid, but it's because of not understanding this, and we're gonna see why most beginner traders are doomed to fail from the get-go. All right, they might as well stop. They might as well stop. Just shut your phone, delete the app, and just stop. The reason is because of position sizing. The reason is because of risk management. Okay, and we're gonna see where that link is in a few seconds. Okay, so let's say I am a trader. Now, this is me. Okay, I've just been introduced to the world of trading and I would like to give it a go. Okay. Now, I'd like to give it a go. However, I only have, let's say I've got about $300, $100. Okay. I've got about $100 and someone on the internet says, I need to risk 1%. Okay. So I'm going to do the math and I'm going to say, okay, what is 1% over $100? That means per trade, I need to be risking $1. As a beginner trader, do you know what I'm thinking? I'm thinking you must be crazy. You think I am wasting my time to do all this TA, all this technical analysis, all this just to risk $1 per trade. Are you mad? All right. That's what the beginner trader is thinking. So the beginner trader thinks, you know what? You don't know what you're talking about. What I'm going to do is I'm going to risk $10 per trade. Or in fact, $10 is nothing. What's that? 2 subways? I'm going to risk $20 per trade. All right. What has this beginner trader just done? This beginner trader he's just screwed himself up. Why? Because he's risked 20%. of his total stack. He's only meant to risk 1%. He has risked 20% of his total stack. That means if he gets one trading decision wrong, he has lost 20% of his portfolio. Now, check this. That beginner trader, all right, without placing many trades, has already started operating with a potential drawdown of 20%. That means in order to reimburse his account back to break even, he has to gain 25%. And that's just one trade. Guess what? For a professional trader to lose 20%, they've got to lose at least 20 trades, which is unlikely. All right. This is the importance of position sizing and risk management. So, can you see why this beginner trader and most beginner traders are doomed to fail? What did I say? Risk management is selecting the right amount of capital per trade. You've already screwed that up as a beginner trader. If you've got $20, you should only be risking about, let's see if my math is good, about two cents. All right. Okay. So you've already broken that rule. All right. So, you're gonna fail. You are gonna fail. And it's okay. It's fine. Just say to yourself, this is not trading, this is just gambling. All right. There's no skill about this. We're just putting the money in. That's fine. If you can admit that, that's fine. All right. But this is why most gonna traders fail, because they do not practice. They don't even know about proper risk management. Now you have to ask yourself, what is the importance of risk management? Well, the importance of risk management is to make sure that in the long run, your system does its thing. Remember, I said in the long run. Long mean 100 trades. Long mean 200 trades. Long may mean in 300 trades. Long may mean in 400 trades. Not necessarily in 3, 4, 5, 6 trades. Okay, so this is where you have to start being aware of what is my trading bias and how can I overcome that bias. Trust me, there are so many biases you pick up. If it's not you being a beginner trader, it's just you going to school. You going to school, having a formal education system, that teaches you your teacher is always right. Look at your teacher. All right. We've been learned and conditioned to think this person is always right. And your parents probably reinforced that. Your parents said to you, do you know what? Listen to your teacher because your teacher is likely to be right. All right, let's see. Where can we find the parents? We'll do Nan. Do a Nan. Now, your teacher's correct. They know what they're talking about. What did these two people do for us? They didn't help us become good traders. Why? Because what they did is they helped us reinforce the idea that to be good at something, you have to be right all the time. You have to be right. Or in trading, that is not the case. In trading, you can be right 50% of the time and be profitable. You can be right 20% of the time and be profitable. You can be right 30% of the time and be profitable. Okay, so you can see how this belief system can impede your ability as a trader. So you come into trading now, you've got a hit rate of about 30, 40, 50%, and you think, do you know what, this is not good enough. I'm not good, I quit. When I know so many traders who have a hit rate of 30%, that means they get 3 out of 10 trades right, and they're still consistently profitable. Okay. Anyways, we'll leave it there for today. All right. Actually, no, I won't leave it there for today because I need to talk to you about this diagram. Now, this diagram is showing you that if you were to have, let's say you started with $10, all right. If you have a 50% drawdown in your account, you need to make at least 100% gain just to get back to break even. If you have a 60% drop in your account, you need to make at least 150% gain just to get back to break even. So why are you risking more than 1% per trade? It makes no sense. And for those of you who do your calculations, quite, how would I describe it? You do it quite what's that word? Lackadaisical. It's quite chill. You just do a quick overview. You can do that, but you're still playing around. Why? Because, hey, listen, you've got these things called fees. You need to take that into your 1% calculations. You got slippage. I can't spell slippage. I need to take that into your 1% calculation. Okay, you've got swap fees. All right, for leaving your trade overnight and all that jazz. You need to take that into consideration. All right. So I just thought I'd leave this one there for you lot. Obviously, we haven't even talked about expectancy, your system quality number. We haven't talked about any of those things. But this is the key one. If you can master this, if you can master this, I promise you, you are above 80% of people using this app right now. Okay. Anyways, let's go and talk about price action, what you came here for. Now, today's price action is looking very, very nice. We had a few trades that I'm sure some of you got into. I'm sure not all of you got into it because you missed the videos when I said get into it. But I'm sure some of you actually got into these trades. And we gave quite a decent amount of trades showing that, hey, listen, we are coming to this low, aren't we? And because we're coming to this low, this is our range low. And because this is our range low, we can look to SFP that low. Because we can look to SFP that low, we can look to long that low. And if we long that low, we can look to make money. All right. And that was, let's say that was around here. I don't think these show it very well. I don't think it shows it very well. Does it? No, I don't think it shows it very well. But if you watch this properly, you know what I'm talking about. We were looking at this zone. All right, first things first. Let's start from the beginning or the beginning. All right, we had a range, and our range actually looks like this: higher high, higher low, higher high, higher low, higher high. So don't be confused. This was the last low in our range. We had this bit of accumulation here that we tried to push us back up, but it was a failed accumulation. It didn't actually bring us back up. Instead, price came back down, all right, and price tagged this level, this range low, SFP that level. It also gave us nice confluence with this 15-minute demand zone. It broke structure here and then it headed up. Okay. That's what that long was based off of. It was simple. It was it was simple range deviation. Now, how could you have entered that trade? Well, the way we could have entered that trade is also very simple. You didn't need an indicator. Nope. You did not need anything other than the charts. And what do I mean by that? So if we time travel and we come back in time, at the moment we're thinking, oh, price is coming down to our level. If it's coming down to our level, we need to check to see what happens at the range low. And not just that, we also need to check to see whether we get a flipping market structure, which is our primary confirmation requirement. Okay, so if we get a flipping market structure, we should look to enter this trade. So at the moment, what has price done? Price starting from here is gone low, low. Actually, I can get rid of that because it's already drawn there. Low, 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 high, low, 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 high, low, 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 high, low, low. And then we're going to get a flip soon. Bang. Look, we get that flip there. So this is where we see a flipping market structure. It retraces and then it heads back up. That was a nice retracement. That was not only a nice retracement, it was a nice retracement that would have given us, let's say we didn't get it right here. Let's say we got it about there. Okay. All right. It would have given us at least a 2x right now. All right. We're not done yet, but it would have given us at least a 2x. Now, price could reverse. All right. It goes without saying it could reverse, but this is where we are right now. And if we look at our risk to reward on that trade, that is giving us a very juicy 2.3x. So if you put 10 grand, you are up 23 grand on one trade. That is nice. That is good money. All right. So what we're looking at is where is that next trade coming from? All right. If you're in that long, all right, great. Take profits, move your stop loss to entry. Depends on your profit target, your risk to reward strategy, your profit taking strategy. Do what you need to do. All right. But if you are looking to get involved in the game and you are seeing this as a range, a lot of people are seeing this as a range, and you're seeing that we have been in the discount of the range for some time and we could be heading towards the premium, then, all right, take a seat, grab your popcorn, and let's see where this potential reaction could come from. So, reaction number one, if this is a flipping structure in purple, as we can see here, it is obvious that if this is a flipping structure, and what I mean by this is we've obviously had a low, a high, a low. We've broken structure here, as we can see. That means a retracement is due. Where that retracement is going to take place, I do not know. But where could it take place? I have some ideas. It could be here. It could be here. It could well be here. And last but not least, I think it all could also be here. Which ones do I prefer? Well, I don't really care. All right, as long as I get my confirmation, I'm going to get in. Okay, but for each and every one of these zones, these are demand zones that we could potentially get reactions from. Okay, and also some of these zones are reinforced with our volume profiles. For example, for the first zone is reinforced with let's see. Let's take this as a range, all right? The first zone is actually reinforced with a value area high from this whole bit as a range, as we can see. Okay. The second zone does not have any reinforcement. I'm sure some fib level reinforces it, but I'm not going to check that. But the third zone is actually reinforced by, you know, a POC of this upward move. So most of the volume that was traded from this expansion leg was around in this region. So this is a point of control. So we could come back down to sweep it. All right. That's what my zones are based off of. Now, these are my continuation zones. That's where I'm going to look for my long. How am I going to enter my long? Well, if price continues to come down here as it's moving, maybe it comes down all the way to the third zone, then gives me a flip, retraces, bang. That's where I'm going to look to enter my long. I'm going to put my long there, put my stop loss here, and I'm going to sweep that all the way to the top for a nice 7-8x. Why not? Okay, that's my confirmation. Very simple, very easy. Set your alerts, wait for your trade, plan your trade, and trade your plan. Okay, all right. So that's what I'm looking out for now. Now. What are we gonna do next? What are we gonna do next if this plan does not work? If we are wrong? Well, if we are wrong and price does not want to come down from here, okay, well, if price decides to actually break bearishly and loses this level, so let's say price comes back, doesn't really give us a flipping structure, all right, then I want to start to panic. The reason I'm going to start to panic is because I realize, wow, we've got this pool of liquidity here that we could sweep. Not only do we have that pool of liquidity, we also have a very steep fall from grace. Look how sharp that rise was. The way that rise was sharp, it could also be a sharp drop. All right. So therefore, I think if we are to lose this level, okay, we may simply just come down a tiny bit more to sweep these guys and head up. That could happen. But if we start to lose this level, I'm going to be looking to prioritize a retracement short. Hopefully, we get a deep retracement, but it is kind of unlikely. All right. But we may just get something like this where it's not necessarily deep, but it just does that and then it heads down. Okay, so I'm going to be looking for levels here when that time comes, but that time is not right now. Okay, so how else am I looking to play this? Well, there's also another short I'm looking out for, and that's this short from this breaker block. When price came down here very rapidly, it was a bit too quick. It was a bit too quick, and because it was too quick, it left what is known as a breaker block, which means price could come up here, find its way up here, and then drop down from there. So I'm going to be looking for a short there, okay, in the case that happens. But the fact we've broken structure now, it makes it a bit less likely. If price had come down here, gone straight for that block, and then come down, that would have given me a bit more confidence. But it didn't do that. But hey, I'm still going to leave that there and watch it. All right, now let's take a look at the grand scheme of things. What's Bitcoin been up to? Well, Bitcoin has been in this range that lasted about 240 days for the most of 2024. It's broken bullishly from this range. Bitcoin can easily just come back down, take a little bit of juice, and carry on up. All right. Now, in order for it to do that, I'm going to be looking for a trade at this extreme, at this zone, and also at this zone here. So that's kind of what I'm looking out for. That's how I'm playing it. Now, I'm not going to be trading as diligently as I normally do. So I'm kind of just leaving this video out there as a bonus for you guys to play around with this week. Tomorrow is Wednesday. we get a lot of big moves on Wednesday. So are we going to get a massive move tomorrow, which is a Wednesday? Are we going to range here for a bit and then drop? Who knows? Anyways, I'll see you next time. Happy trading.